China's latest moves are transforming and reverberating through global trade and finance. By slashing U.S. corn imports, selling American debt, and stockpiling gold, Beijing is directly challenging Washington's grip on the global economy. Could this mark the beginning of a new global financial order? And what are the broader implications for international stability and your own economic future? Let's dive into the full picture. The U.S. has spent the past decade attempting to decouple from China, citing national security and economic sovereignty. Policies restricting Chinese access to critical technologies like semiconductors and tariffs on goods are part of this strategy. However, these measures have led to costly ripple effects. Since 2018, tariffs have cost U.S. businesses over $125 billion, according to a report from the U.S. Chamber of Commerce. China responded by diversifying its trade partners and reducing imports of American agricultural goods. At the same time, Beijing has reduced its holdings of U.S. Treasury bonds, signaling a shift away from the dollar-based financial system. The decoupling isn't just affecting trade. It's creating seismic changes in global financial systems. As the U.S. pulls back, China is building alternative trade routes, stockpiling strategic resources, and deepening ties with other nations. Please like and subscribe. Leave your thoughts in the comments. Your support helps us grow. Thank you. The U.S.-China trade war began as a battle over tariffs, but quickly expanded into a full-blown economic standoff. Beijing's agricultural imports were among the hardest-hit sectors. U.S. soybean exports to China fell by 75% in 2018, while corn and pork exports suffered similar declines, according to USDA statistics. In response, China turned to Brazil and Argentina for soybeans and corn and negotiated trade deals with Russia for wheat. These moves were not just retaliatory. They were a calculated effort to reduce reliance on U.S. agriculture. By 2023, Beijing's import diversification strategy was firmly in place, ensuring a steady supply of essential goods while reducing vulnerability to geopolitical tensions. For American farmers, the numbers are devastating. In 2023, U.S. corn exports to China dropped by 30%, resulting in an estimated $1.2 billion in losses. Farmers in Illinois and Iowa, the heart of America's Corn Belt, have been hardest hit. Many are grappling with reduced demand and falling prices, forcing some to scale back operations. The secondary repercussions extend beyond the farm. Local businesses that depend on agriculture, from machinery suppliers to grain elevators, are seeing declining revenues. One farmer in Illinois told Bloomberg, "This isn't just about crops. It's about the survival of entire rural communities." The broader question is whether the U.S. can find alternative markets to replace China, or if these losses will deepen over time. Brazil has emerged as the new king of corn exports, surpassing the United States as China's top supplier in 2023. This shift didn't happen overnight. Years of investment in infrastructure, combined with record-breaking harvests, positioned Brazil to step in when U.S.-China relations soured. According to Brazil's Ministry of Agriculture, exports to China increased by 136% year-over-year in 2023. The 2022 trade agreement between Beijing and Brasilia sealed the deal, ensuring steady agricultural flows. For China, this partnership is about more than just corn. It's about building long-term resilience in its supply chains. The United States now faces a tough question. Can it compete with Brazil's competitive pricing and growing ties to China? China's pivot to multiple suppliers is a textbook example of risk management. By spreading its imports across nations like Brazil, Argentina, Ukraine, and Russia, Beijing ensures it isn't overly dependent on any single country. Russia, for example, has become a key supplier of wheat, while Ukraine, despite ongoing conflict, continues to export corn to China. Argentina has also seen a surge in soybean exports, driven by favorable trade agreements. This diversification not only strengthens China's food security, but also reduces its exposure to potential sanctions or trade disruptions. For the United States, this trend represents a significant loss of influence in global agricultural markets. China is investing billions in agricultural innovation to boost domestic production. In 2022 alone, the government allocated $10 billion to R&D in precision farming, gene editing, and AI-powered irrigation. One standout achievement is the development of drought-resistant corn varieties using CRISPR technology, which has already improved yields by 20%. Smart farming systems powered by AI are optimizing planting schedules and reducing waste. These advancements are not just about increasing productivity, they're about reducing China's reliance on imports. If successful, Beijing could achieve near self-sufficiency in key crops within the next decade. China's sell-off of U.S. Treasury bonds is making waves in global financial markets. As of 2023, Beijing's holdings fell to $805 billion, the lowest level in 14 years. This move reflects a broader strategy to diversify away from dollar-denominated assets. Selling treasuries increases U.S. borrowing costs as it forces Washington to find alternative buyers. Economist Stephen Roach warns, China's actions are a wake-up call for the U.S. to rethink its reliance on foreign capital. The long-term impact of this sell-off could reshape global finance, reducing the dollar's dominance as the world's reserve currency. China has reduced its U.S. Treasury holdings by more than 35% since their peak in 2014. This trend isn't isolated. Other nations like Japan and Saudi Arabia have also reduced their exposure to U.S. debt. For China, this is part of a broader strategy to insulate itself from potential sanctions and diversify its financial reserves. For the U.S., it signals a shift in global confidence. As fewer nations rely on the dollar, Washington faces mounting pressure to maintain its fiscal credibility. In 2023, global central banks purchased over 1,136 tons of gold, the highest level in history. China alone added over 200 tons to its reserves, according to the World Gold Council. Why the rush to gold? It's simple. Gold offers stability in times of economic uncertainty. For nations concerned about inflation, sanctions, or geopolitical risks, gold is a safe haven. This trend is challenging the dollar's role as the default global reserve currency, as more nations look for alternatives. China's gold strategy goes beyond simple hedging. By amassing gold reserves, Beijing strengthens its ability to settle trade deals in non-dollar currencies. This is especially important as China seeks to promote the yuan in global finance. Gold also provides leverage in financial negotiations, allowing Beijing to reduce its exposure to dollar-based risks. As global instability rises, China's gold reserves give it a critical edge in shaping the future of international trade. Declining demand for U.S. Treasuries is already raising borrowing costs. In 2023, yields on 10-year Treasuries reached nearly 5%, the highest level in over a decade. This trend increases the cost of everything from mortgages to infrastructure projects. For the U.S., this poses a serious challenge. How do you maintain fiscal stability when traditional buyers like China are stepping back? The answer may lie in domestic reforms, but the road ahead is uncertain. Gold's appeal as a reserve asset lies in its stability, universality, and independence from political influence. Unlike the US dollar, which can be weaponized through sanctions or manipulated by monetary policy, gold is immune to external control. For nations like China and Russia, this makes it a strategic tool for bypassing dollar-dominated systems. In 2023 alone, China added over 200 tons of gold to its reserves, part of a broader trend of central banks globally purchasing over 1,136 tons, according to the World Gold Council. This surge in gold reserves reflects a growing desire among nations to hedge against inflation, economic instability, and the risks associated with over-reliance on the dollar. Gold also facilitates trade settlement outside traditional financial systems like SWIFT, which is dominated by Western interests. For China, stockpiling gold aligns with its long-term goal of promoting the yuan in global trade and reducing its exposure to U.S. economic policies. This shift toward gold represents a quiet but significant rebellion against dollar supremacy, reshaping the landscape of international finance. China's actions are undeniably accelerating the shift toward a multipolar financial system. By reducing its reliance on the dollar, promoting the yuan, and stockpiling gold, Beijing is laying the groundwork for a new global order. However, the transition won't be easy. The dollar remains deeply entrenched in global finance, and alternative systems face significant hurdles. The real question is whether this shift will happen gradually or trigger financial upheaval. A decline in dollar reliance could lead to a more fragmented global economy. For the U.S., this means less influence over international trade and higher borrowing costs. For nations like China, it represents an opportunity to redefine the rules of global finance. The consequences couldn't be more significant. As the dollar's dominance fades, the balance of economic power is shifting, reshaping the global financial system and impacting economies worldwide. China's moves are reshaping the global economy. By cutting U.S. corn imports, selling debt, and stockpiling gold, Beijing is challenging Washington's financial dominance. But this is only the beginning. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.